This week, the Federal Reserve Bank of New York published data that every American needs to see. Total household debt in the United States just crossed $18.8 trillion. Credit card delinquency rates are the highest they have been in 16 years. Auto loan delinquency just hit an all-time record, and 2.6 million Americans defaulted on their student loans in the first 3 months of 2026 alone. In the next 8 minutes, you are going to understand exactly what these numbers mean for your financial life, why they are happening right now, and the 3 concrete steps that separate households that survive this kind of economic pressure from the ones that get crushed by it. This is the Vault Keeper. Let me start with the Federal Reserve Bank of New York data, because it was published this week and it tells a story that the mainstream financial media is not connecting properly. The share of Americans behind on a range of household consumer debts reached all-time highs in the first quarter of 2026. Credit card delinquency rates are now the highest they have been in 16 years at 13.1%. Auto loan delinquency just hit an all-time record, and student loan delinquency soared to 10.3%, the highest recorded since 2020, JP Morgan. But here is the detail that makes this data genuinely alarming. Delinquent borrowers are likely to be behind on more than one type of loan at once, a sign that consumers are caught in a perfect storm of financial strain as prices rise and savings thin. JP Morgan. That is the critical phrase. A perfect storm. Not one problem, not 2 problems. Multiple financial pressures hitting the same household simultaneously. And the data confirms exactly that. Among borrowers who recently defaulted on student loans, nearly 40% of those with auto loans are past due, 56% of those with at least one credit card are past due, and 20% with a mortgage are past due. World Gold Council. The same household, behind on the student loan, behind on the car, behind on the credit card, behind on the mortgage, all at the same time. That is not a personal failure story. That is a systemic pressure story. And understanding the difference is the foundation of making better financial decisions in this environment. Now let me show you the 5 forces that created this perfect storm. Because each one is documented, each one is measurable, and each one is still active right now. Force 1, 19 trillion in total household debt. As the nation hurdles toward a historical record of $19 trillion in total household debt, the average American household is carrying a debt load that requires a significant portion of monthly income just to service, before buying food, paying rent, or saving a single dollar. Credit card annual percentage rates currently average around 20%. When you are carrying a balance at 20% interest, the debt is not just standing still. It is compounding against you every single month. A $5,000 credit card balance at 20% interest costs approximately $1,000 per year in interest alone. That is money that goes directly to the bank and directly away from your financial progress. JP Morgan. Force 2, 2.6 million student loan defaults in 3 months. Roughly 1 million borrowers fell into default during the fourth quarter of 2025, and another 2.6 million borrowers did so in the first quarter of 2026. That is, 3.6 million Americans whose student loans entered default in just 6 months. A federal student loan default is not a minor financial setback. The federal government has extraordinary collection powers. It can seize borrowers' tax refunds, paychecks, and Social Security retirement and disability benefits. And the damage to your credit score from a student loan default follows you for 7 years, affecting your ability to rent an apartment, buy a car, get a mortgage, or in some cases, even get a job. Bullion Trading LLC, a recent report from Fidelity Investments found that nearly 1/3 of those currently paying off student loans have delayed purchasing a home due to their debt. And the percentage is even higher among Gen Z and millennial borrowers, 37% and 36% respectively. Fortune. Student loan debt is not just a monthly payment problem. It is a wealth-building delay problem. Every year that a household delays buying a home because of student loan debt is a year that household is not building equity, not benefiting from property appreciation, and not reducing their housing cost over time. Force 3, living paycheck to paycheck at record rates. Half of Americans, 51%, are living paycheck to paycheck. That number has not meaningfully improved despite years of strong job market data and nominal wage growth. Why? Because wage growth has been consistently outpaced by the cost of living. About half of U.S. adults, 52%, worry daily about their finances. And 34% of Americans, 88 million U.S. adults, say they are struggling or in crisis with their finances. 88 million Americans. That is more than the entire population of Germany, struggling or in crisis with their personal finances right now. That is not a marginal issue. That is the defining economic reality of the American middle class in 2026. Force 4. The Fed is not coming to the rescue anytime soon. The Federal Reserve is deeply divided on what comes next. For Americans carrying debt or planning major purchases, this means interest rates will remain elevated for much of the year, keeping monthly payments higher than they were just a few years ago. The Mercury. For prospective homebuyers and those hoping to refinance, the relief they expected from Fed rate cuts has not materialized. Monthly mortgage payments remain elevated, and housing affordability continues to be a major barrier for many Americans. Experts do not expect rates to drop meaningfully below 6% in the near term. The Mercury. That means the household that was hoping to refinance their mortgage and free up $400 per month in cash flow is going to keep waiting. The household that was planning to buy a home is going to keep renting. And the household carrying credit card debt at 20% interest is going to keep paying that 20% because the Fed's rate cuts are not reaching consumer borrowing costs in any meaningful way. Force 5. AI-powered financial scams are exploding. This is the force nobody is talking about in the context of household financial stress. The FTC warned in early 2026 that AI-powered scams increased 340% year over year, with losses exceeding $2.7 billion. The most dangerous scams use AI to create personalized messages based on scraped social media data, making them eerily specific and convincing. When a household is already financially stressed, already living paycheck to paycheck, already looking for any way to improve their situation, they are uniquely vulnerable to scams that promise easy money, debt relief, or financial shortcuts. AI-generated deepfake videos of financial celebrities endorsing fake investments. AI-written phishing emails virtually indistinguishable from legitimate bank communications. AI voice cloning that can mimic your bank's customer service representative. The financial pressure that the data shows is real is creating the exact psychological conditions that make scams most effective. Now here is the part that actually matters for your financial life. What do you do about it? The data we covered is real. The pressure is real. But the households that navigate this kind of environment successfully are not the ones who panic or give up. They are the ones who understand the system well enough to make better decisions than the system is designed to encourage. Here are the 3 concrete steps that separate households that build wealth through difficult economic periods from households that fall further behind. Step 1. Know your complete financial picture before you make any other decision. This sounds obvious. It is not being done. 37% of Americans feel managing money is too overwhelming and they are not sure where to even begin. And you cannot fix what you cannot clearly see. Most Americans with financial stress have a fragmented picture of their own finances. They know their checking account balance. They have a vague sense of their credit card balance. They know their student loan exists, but avoid looking at the current balance. They have not opened their 401k statement in months because the numbers were going in the wrong direction. That fragmentation is expensive. When you cannot see your complete financial picture in one place, you cannot make the decisions that would actually improve it. You cannot see that the money sitting in a low-interest savings account could be paying down high-interest credit card debt. You cannot see that you are paying $200 per year in 401k fees that could be eliminated. You cannot see that your debt-to-income ratio is affecting your ability to get the mortgage rate you qualify for. Personal Capital is a free tool that connects to all of your financial accounts, your 401k, your IRA, your bank accounts, your credit cards, your loans, and shows you your complete net worth, your complete debt picture, and your complete investment fee structure in one dashboard. It takes approximately 5 minutes to connect your accounts. The clarity it provides is the foundation of every other financial decision. The link will be in the description as soon as our affiliate account is approved. In the meantime, go to personalcapital.com and search for their free tools. Step 2. Attack your highest interest debt first, not the biggest balance, the highest rate. The most common mistake Americans make when trying to pay down debt is focusing on the biggest balance rather than the highest interest rate. The mathematical reality is that every dollar of credit card debt at 20% interest costs you 20 cents per year. Every dollar of student loan debt at 6% costs you 6 cents per year. Eliminating the 20% debt first generates a 20% guaranteed return on every dollar you put toward it. No investment in today's market can guarantee 20% returns. Paying down 20% credit card debt is the highest guaranteed return available to most American households. The specific order of operations. First, make minimum payments on everything to protect your credit score. Second, put every additional dollar toward the highest interest rate debt until it is eliminated. Third, roll that payment amount to the next highest rate debt. This is called the debt avalanche method, and it is mathematically optimal for reducing total interest paid over time. Step 3. Build a 1-month emergency fund before you do anything else. A little over a third of Americans, 38%, say they spent more than they planned last month. For households living paycheck to paycheck, the absence of an emergency fund is the single most expensive financial condition that exists. Because without an emergency fund, every unexpected expense, a car repair, a medical bill, a home appliance failure, goes directly onto a credit card at 20% interest. That transforms a $600 car repair into a $720 car repair after interest, and a $720 car repair after interest into a cycle of minimum payments that keeps that debt alive for years. A 1-month emergency fund, not 3 months, not 6 months, 1 month of essential expenses held in a savings account, breaks that cycle. It means the next unexpected expense is covered by savings, not debt. It means you stop adding to the high-interest debt pile at the exact moment you are trying to reduce it. The math on this is stark. A household that builds a $2,000 emergency fund before aggressively paying down debt and then never adds new debt to a credit card saves an average of $340 per year in interest on a typical American credit card balance. Over 5 years, that is $1,700 in interest saved from a $2,000 fund. That is an 85% return on a savings account. Now let me give you the honest context. 32% of Americans think their personal finances will worsen in 2026, the highest level of pessimism since Bankrate began asking this question in 2018. That pessimism is not irrational given the data we have covered. But pessimism without a plan is just anxiety, and anxiety without action makes every financial problem worse over time. 53% of Americans report an increase in financial stress over the past year, and 61% identify money as their primary life stressor, but 76% feel confident that their finances will improve in 2026. The gap between stress and optimism is exactly where the Vault Keeper lives, understanding the problem clearly enough to act on it specifically. The data from this week is not good. 18.8 trillion in household debt, record auto loan delinquencies, credit card delinquency rates not seen since 2008, 3.6 million student loan defaults in 6 months, half of America living paycheck to paycheck. These are real numbers from the Federal Reserve Bank of New York published this week. But the household that knows these numbers understands the mechanisms behind them and takes 3 specific concrete actions, seeing their complete financial picture, attacking highest interest debt first, and building a 1-month emergency fund, is in a fundamentally different position than the household that is experiencing the same pressures but does not understand why or what to do about it. That is the entire purpose of this channel, not to make you more anxious about money, to make you more capable of managing it. Drop a comment below. Are you currently carrying credit card debt or student loan debt? Tell us what state you are watching from. I read every comment and I will give direct feedback on the strategies that apply to your specific situation. Subscribe to the Vault Keeper newsletter for daily financial intelligence before markets open. Link is in the description. Subscribe, turn on notifications. Data before price. The Vault Keeper.